Today, we're going to dive into a really fascinating economic puzzle. You see, Europe is one of the wealthiest places on Earth, just swimming in savings. But a huge chunk of that money isn't actually staying home to build Europe's future. So let's get into why. It all starts with what you could call a paradox, something at the very heart of Europe's economy, that when you first look at it, just doesn't seem to add up. And here it is, the core mystery we're going to unpack. Europe clearly has the cash, but for some reason, it's struggling to fund its own absolutely critical investments. The big question is, where is all that money going? Well, a huge piece of the puzzle is this number, an estimated 400 billion euros. That is how much European savings flows out of the continent and into the United States every single year. That's just an astonishing amount of capital leaving home. So where is this all coming from? Well, it starts with Europe's current account surplus. Now, in simple terms, that just means the continent as a whole is saving way more than it's investing in its own backyard. This creates this giant pool of extra cash, and all that cash is looking for a place to go. Okay, so you have all this cash flowing out. Now let's stack that up against this number. According to the recent Draghi report, Europe needs an extra 800 billion euros per year for vital investments in things like the energy transition, digital tech, and of course, defense. And that really gets to the heart of the problem. The money is there. The need is clearly there. But for some reason, they are not connecting. It's kind of like having a full water tank during a drought, but you can't get the tap to turn on. So why? And what could possibly be done about it? Well, this leads us to a really powerful and, on the surface, pretty simple idea for how to solve this exact problem. The proposition is incredibly straightforward. Just keep the money at home. If Europe could somehow redirect all those savings inward, it would unlock about 500 billion euros for investment every single year. And the potential impact here is huge. That 500 billion euros would cover over 60% of that massive investment gap we just talked about. I mean, it would be a total game changer. So why isn't it happening? Well, as it turns out, this simple idea slams right into four enormous, complex, and really deep structural hurdles. It's not nearly as easy as just asking investors to be a little more patriotic with their money. So let's break these four obstacles down one by one to really understand why the US is such a powerful magnet for global capital, including Europe's own savings. First up, public debt. The US Treasury market, it's like a massive 12-lane superhighway. It's absolutely huge, it's unified, and it's incredibly easy to get on and off of. European debt markets, on the other hand, are more like a network of smaller, separate country roads. They work, sure, but they just don't offer that same scale or ease of use. And you can really see the difference in scale here. The single US public debt market just dwarfs the individual markets of even Europe's biggest economies. For those huge global investors, the sheer size and simplicity of that unified US market is just incredibly attractive. All right, hurdle number 2 is the stock market. And you're going to see a very similar story. The US equity market is simply in a different league when it comes to size and depth. It just has more companies and many of the world's largest companies listed on its exchanges. I mean, just look at this chart. The gap in total market value between US and European companies is vast, and it's actually been getting wider. Capital, it naturally flows where the biggest opportunities are. And right now, that is disproportionately in the United States. Hurdle number 3 is all about the financial system's plumbing. For years, the EU has been trying to build something called a capital markets union, basically a single, seamless market for investment. But it's not done yet. So investing across 27 different countries with 27 different sets of regulations and bankruptcy laws is just way more complex and expensive than investing in the single, unified US market. Now that brings us to the 4th hurdle, and you could argue this is the big one, maybe the most fundamental of them all, profitability. Because at the end of the day, capital follows returns. This all comes down to something called return on equity, which is really just a key measure of how profitable a company is for its investors. And the data here is crystal clear. US companies consistently deliver higher returns than their European counterparts. Money is rational. It goes where it's treated best. So, of course, that begs the next logical question, right? Why? What's actually driving this profitability gap? Well, it's not just one thing, but a major factor is technology. A huge part of the answer is the US tech advantage. First off, its tech sector is just a much bigger piece of the overall economy. And second, the US invests a much larger share of its entire GDP into technology. This creates this really powerful, virtuous cycle of innovation and, you guessed it, profitability. And if you want to see the root of that tech gap, look no further than this. This is the fuel for future growth. In 2024, European startups raised 22 billion euros in venture capital. In that same period, US startups raised 250 times billion dollars. That is a staggering, more than 10-fold difference in funding for the high-growth companies of tomorrow. That is not a gap, that's a canyon. So when you piece all of this together, the markets, the regulations, the returns, a really clear picture emerges. And it's a picture of a massive, systemic challenge. So let's just quickly pull it all together. Keeping European savings in Europe isn't a simple fix. It means tackling these 4 huge issues: creating a debt market that's as deep and seamless as the one in the US, growing its stock market, finally completing a true single market for capital, and closing that corporate profitability gap. And all of that leaves us with this final, absolutely critical question. This isn't just about finance, This is about economic sovereignty. Solving this puzzle is one of the most significant strategic challenges facing the European Union today. And the answer will really determine its ability to shape its own destiny for decades to come.